Hi, welcome to IME 315. This is the third and final lesson for week 1. When we're done with this lesson, you should have all the ammunition you need to finish the first homework assignment. And what I'm going to talk about right now is different ways to use financial information from the 3 accounting statements to judge the health of a company. And there's 5 different categories of financial ratios I'm going to talk about. And these financial ratios are means to determine what's good and what's maybe not so good about a company, and to determine how it's performing. Now, the ratios in and of themselves are not all that useful as one number. It's important to compare them from year to year to see how things are changing. Also, it's important to compare industries. So a ratio of a certain amount, like let's say 10% for Apple, might be different than a ratio of 10% for the same calculation for Chevron. And when I say 10%, I'm going to go through the ratios and show you the different means of calculating them. So it tells you what's important about a company, and there's no absolute standards. So we need to look at trends comparing from year to year. We need to compare in different industries and maybe different company structures. So maybe you can compare 2 companies that have a similar financial structure that are in different industries, but there's no absolute standards. And recognize that the goal of this lesson is not to make you expert accountants, but to understand the calculations and just have a talking knowledge of what they mean. So the 5 categories are liquidity, how much cash. Liquidity means how much cash does the company have, how quickly can they get cash. If they're illiquid, it may mean they're a good solid company, but they don't have any cash in the bank, and that can kill a company. Working capital utilization, this is really important. What it means is how much money does it take to generate sales. So when you say working capital utilization, it means, let me give you an example. I have a farm. I have sales throughout the year. So I generate cash throughout the year. However, I have most of my expenses at the end of the year when I pick my olives. I have an olive farm and I make olive oil. I pick my olives and I turn them into olive oil. So I have a lot of working capital. It's cash ready, necessary to run the business. And you want to be really efficient in your working capital utilization, especially when you're a small company. The third one would be capital structure. Capital structure is how much debt and how much equity is there in the company. Finally, there's profitability and cash adequacy, and I'll explain those as we go along. But keep in mind that the most common ones that you'll see as engineers will be liquidity and capital structure type ratios. So if we refer to the Chevron balance sheets from the balance sheets and income statements from the prior lesson, we have the first ratio I want to talk about is the current ratio. It's simply the ratio of current assets to current liabilities. And this is very easy to pick off the balance sheet. It was 1.07 for Chevron in 2019, 1.25 in 2018. The big deal is to recognize this number changing from year to year. A ratio should be greater than 1, but for a large company, it's not necessary for it to be greater than 1. Now, when we talk about financial ratios and liquidity, the current ratio is by far the most common one that's referred to. Now, the acid test ratio is the same as the current ratio, except it backs inventory out of the denominator, or out of the numerator. And that's because the idea is how much cash can you get to quickly. Well, if you need cash in an emergency, how quickly can you get it? The current ratio backs out inventory because to sell all your inventory could take some time. Yes, you can probably do it all within several months, but if you needed it all within a month, you would have to, you probably couldn't sell all of your inventory within a month. The acid test ratio isn't used nearly as often as the current ratio. So those are the two liquidity ratios. Now, working capital utilization, it's how are we using the money in our balance sheet. And so we have several of them. Accounts receivable collection period, how quickly do we collect our receivables? And here's the definition: accounts receivable divided by average sales per day. So this is usually you have a period. So your income statement is either going to be a quarterly statement or an annual statement. Here, the number comes, these are annual numbers, therefore we divide by 365. And typically, a company would have a net 30 payment plan. So you sell something and the payment terms are you pay everything within 30 days, kind of like how our utility bills work. Now I don't use accounts receivable that much right now, but inventory turnover and flow I use a lot in analyzing a company. And turnover is your cost of goods sold divided by your average ending inventory. So your average ending inventory, how many times do you turn over your inventory a year? And what you want to know how this number changes from year to year. That's the big deal. How much do these numbers change from period to period? And is that change significantly positive or significantly negative? Now, I think you can start to see why when you start to compare these numbers, it doesn't necessarily make sense to compare an Apple, which is in the technology industry, to a Chevron. The numbers just are not that meaningful to compare the two of them. You would want to compare Apple to Samsung, or you might want to compare Facebook to Google, those types of things. Chevron to Exxon, Chevron to ConocoPhillips, those kind of things. We have an accounts payable payment period and working capital turnover. Working capital turnover is really important. It's how often do you turn over your working capital a year. If this number is really high, it might mean that you don't have enough working capital to support your sales growth. If sales grow a lot, you may not be able to support it. And let me talk a little bit about this startup company that I'm working with. We are looking very closely, at the inventory turnover and working capital turnover. Those are two things that can kill a small startup company. So we want to be sure that we clearly understand what they are. We have our sales divided by our net working capital, our current assets minus our current liabilities. And this is an average number. So this is for 2019, this is for 2018, and this is our sales in 2019. So I do use those numbers, but typically as engineers, we wouldn't be using those numbers a lot. Those are more business-oriented numbers. However, when we start to talk about the capital structure, this is just kind of these are kind of interesting numbers to understand when you talk with others in a company. When you talk with, like when I talk with investment banks, these are very, very important numbers for companies to understand. And the first one, total debt to owner's equity. That sounds like debt to equity, and it's just what it's described as, and it's just debt over equity. That's not used very often in industry. The number total debt to total assets is used in industry, which same numerator, current liabilities and long-term liabilities, but basically your total assets in the denominator rather than the total shareholders' equity. Now, I want to stress here is that companies, investment banks will call this total debt to total assets. They'll call it the debt ratio, or they might call it the debt equity ratio. And that's directly in conflict with the total debt to owner's equity. But just be aware when you get into industry and you're talking about these numbers to understand how these numbers are put together. Let me give you a very specific example. When I worked for Unocal, the debt to total asset ratio was a number that was in one of the covenants. That's a rule for our loan agreements. And there's very different ways that the term is understood in industry. So I wanted to be absolutely clear of what we meant when we said the debt to asset ratio. So I actually, in the loan agreement with the lenders, we put in a specific example referencing specific actual numbers so that there would be no confusion as to what the calculation was and what it meant. And then this third term, long-term debt to total capitalization, it's almost this debt to total asset ratios. What's pulled out of here is the short-term portion, the current liabilities portion. And this will also be called the debt equity ratio or the debt ratio in industry. So it's important to recognize when you're in industry that these terms can have different meanings to different companies. Now, if you're an accountant, these are the defined terms. But for working knowledge or for working utilization when you're talking with investment banks, which probably as young engineers you won't be, I think that you just need to recognize that it can have different meanings. Now, for your perspective, for an exam or something, I'm not going to be real. I'm not going to try to fool you with this. And I'm going to, when I ask you something, I'm going to try to explain clearly what I'm looking for. Again, all of these numbers should be relatively stable from year to year. And if they change a lot from year to year, that's when you want to explore with look into the company as why are these numbers changing. Now we have profitability ratios as well, and this is something that an investor is going to look at very closely. And one of the things that you want to look at is your gross margin, which is basically your sales minus your cost of goods sold divided, or revenue minus the cost of goods sold divided by revenue. And that is the money that's left over to cover your operating expenses. So in the case of Chevron, in 2019, they spent, 57% to cover their cost of goods sold, and they have 43% left to cover their operating expenses. And then we have some numbers that analysts like to look at. Return on sales. Now this is a number that's varies from industry to industry, and analysts love to look at this. And in 2019, if you look at this, Chevron had a return on sales of 2%, and in 2018 it was 9.3%. That's a tremendous difference. And so if I was looking at Chevron as an investment, I would actually go in and say what changed from 2018 to 2019. And what changed was the price of oil dropped quite a bit in 2019, and therefore the profitability was significantly less. Return on equity, net income divided by average equity, opening equity, average from the beginning to the end of the period. This is an important number. This is how much money is effectively returned to the shareholders That's how much they're earning. It may not be given to them in dividends. It may be reinvested in the company, but that's how much is available. So 2 cents for every dollar of equity, so 2%. Kind of low for 2019. That's a kind of a low number. I can't tell you that, well, I can tell you that every industry will have a different number, but 2% in general is a low number. Typically, you will see technology and high-tech companies have numbers 15 to 20% potentially. Okay, so we have return on sales, return on equity, return on assets. Basically, this is earnings before interest. It should be interest, depreciation, and taxes divided by average assets. And it's basically how much money are your assets generating. So it's very similar conceptually to return on equity. Equity is assets or debt plus equity. This is just total assets. The fifth one here, earnings per share. It's net income divided by the average shares outstanding. This is a very important number. Chevron has $1.55 earnings per share in 2019. Now, I believe in 2019, Chevron paid about a $4 dividend. So if you look at that, it's basically saying they're not earning enough to cover their dividend. And so what has to happen is they're going to pull it out of prior year's earnings to pay their dividend. But a company cannot pay more out in dividends than they earn for a very long time without going bankrupt. Chevron's not in any danger of going bankrupt, but that's kind of the interpretation of it. And then the cash adequacy, so all of the others are balance sheet, income statement type numbers. The cash adequacy is so a lot of times your cash from operations is a whole lot different than your net income. And the primary difference is because of depreciation, which we'll talk about later on in the corner. But if this number is significantly greater than 100%, you typically have high non-cash deductions. That's depreciation. Cash from operations, the cash flow for investments. Again, this is the cash the company's generating, the $27 billion. And the cash used for investing is what you're reinvesting the money in. So they had $27 billion of cash that they generated. They took 14 billion of it and put it right back into the company. And they still effectively had about $13 billion left, of which a whole chunk of that was used for dividends. Let's go back here to the prior slide where I said this number, $1.55, was very low. They earned on the balance sheet, on the income statement, almost $3 billion, but they had almost 10 times as much. They had 9 times as much, $27 billion of cash. This is not intuitive. Hopefully by the end of the quarter it will make a little bit more sense. And finally, cash flow from operations to owner's equity. And so this is basically saying how much of a return did the owners get in a cash basis. So the equity is the ownership of the company. The cash flow from operations is the true cash generated by the company. 18.8% or almost 20% is a very good number for any company. So what can we do with this information? Well, let's look at a company that has a gross margin of 45%. If they have revenue of $2,500, what is their cost of goods sold? So their gross profit is their revenue minus their cost of goods sold. The gross margin is this gross profit, and gross margin is many times used for gross profit, and that's divided by revenue. So we know what revenue is, we know what gross margin is. We can back into gross profit because we know that it's 45% of $2,500, and because of that we can back into cost of goods sold. Another example, Company has return on sales of 9%. If we know they have net income of $300, what is their revenue? We know their net income is $300. Return on sales is net income divided by revenue. So 9% equals net income, which is $300 divided by revenue. So we have $300 divided by 9%, or $3,333 is their revenue. So let me talk a little bit about the first homework assignment. First homework assignment, I want you to be able to go to the Edgar system, pick a company of your choice, go to the Edgar system, and basically download into Excel the income statement, the balance sheet, the cash flow statement. Now you can grab this off of other sources, but I think the example I showed you with Edgar and the SEC website makes it relatively straightforward. And then what I want you to do is use the information in Excel, and so don't do it by hand. I want you to calculate the various ratios we just discussed in this lesson. And so there's a number of ratios. You're going to have to do it for a couple of years. I don't want you to do multiple downloads. I think if you do it for 2 years, you're going to be in good shape. And then draw conclusions. And when I say draw conclusions, it's not a paragraph. It's a couple of words, maybe a sentence about what each one of these ratios means. And then finally, I want you to pick 2 other companies in the same sector or industry of the company you chose. Do the same thing, download their kind of financial statements, but just pick 5 ratios of your choice. Pick something like the current ratio, the debt to total assets ratio, net earnings per share ratio, working capital turnover. Pick 5 of them. And then calculate those ratios for these 2 new companies, compare them to the ratios from the company you picked, and make a couple of brief comments about how those 2 companies performed compared to the company that you chose. Now, this is going to take you a little bit of time. I think the most difficult part is going to be to download the information. But it's not just a matter of calculating ratios, it's looking at them and thinking about them and making a comment. So even though it may be a sentence, it's more than a 30-second thought. Hopefully you put a little bit of thought into it. If you have any questions on it, you can send me an email, send me a text. My office hours from Wednesday from 5 to 6 or Fridays from 8 to 9. I'm happy to go over them with you. If that doesn't work, we can probably find another time that we can get together and just send me a text and we'll try to find a time to work on it.